In this video, we're going to work on a problem you can download from tonybell.com. Go to the website, click the PDF link, and you'll notice there's no sign in, no sign up. The PDF just pops right up. You'll scroll down and find whatever problem it is that we're working on. As you scroll through the problems, you'll notice many are free and open, like the one you're watching now, but some are members only. I think the free and open ones are enough for most people, but if you can't get enough of me and you'd like to join and get access to those members only videos, click the join button underneath the YouTube play box. All right, thanks so much for watching. Let's get started. Let's jump into problem 8.2a. We're doing break-even points again, and we've just done this. If you've done 8.1, you've seen the accounting break-even point. Fixed costs, including depreciation, divided by the price minus the variable cost, I should say, per unit. And this is called the contribution margin in accounting jargon. So let's jump through the problem. We're going to calculate the accounting break-even point. We've already done that. We're going to calculate the cash break-even point. Again, we did that in 8.1a, but the new material here is parts C and D, and pay particular attention to part C. That's the new ground we're breaking. Part D, we're going to explore more in problem 8.3, operating leverage, but we'll get to that when we get to it. Let's jump into the accounting break-even point. So here we have a company that's considering a project with the following information. Selling price of the product they're going to make is $80. The variable cost is going to be 50, fixed cost of 60 grand, and they got to make an additional initial investment of $20,000. It's going to run for 5 years. So, assuming they're buying some asset or assets to produce this return, it's 50,000. No, not 50. 20 divided by 5 is $40,000 per year in depreciation, which I will put as depreciation. Assume the company wishes to use straight line depreciation. Well, we just did that. And assume taxes are ignored. Okay. I'm ignoring them now. The required rate of return is 10%. I love ignoring tax. I wish I could ignore taxes in my real life. The required rate of return is 10%. Okay, so discount rate. Now, the discount rate doesn't come into play in these first two calculations. It rarely comes into play in accounting. A discount rate is for finance, where we're doing these longer term projections. Accountants can use a discount rate, but it's less frequently used in accounting exercises. So in any event, the first two parts of this problem, we don't need to worry about that required rate of return. Let's calculate the accounting break-even point. Fixed cost plus depreciation, 60,000 plus 40,000. divided by price minus variable cost per unit, 80 minus 50. And let's crunch that number. 100 divided by 30, right? 60 plus 40 is 100,000 divided by 80 minus 50, which is 30. 33333. So 3,334 units. That's our break-even point, according to the accountant. And remember what break-even point means. The accounting break-even point is the point where net income is 0. And I always bring this up, like, you don't run a business to break even, so why do you care about the break-even point? You want to make money. And the answer is, you don't run the business to break even, but it's still useful to know. Oh, once I've sold my 3,334th unit, everything after that is gravy. I'm making profits after that. So if you're running a business and you're like, I'm not going to reach 3,000 units, you know you're going to be losing money. And you can project based on that information. So it's useful information to have in your back pocket. Also useful information is the cash break even, which is, are we going to run out of cash? That's useful to know. And it's easier to hit the cash break even than the accounting break even. Why is that? Well, look at the formula for break even, the accounting one, fixed cost plus depreciation divided by price minus variable cost per unit. The cash break even just says, take out that one because there's no cash flow, right? And we're in finance, we're worried about cash flow. So take out the piece that has no cash flow. We'll go fixed costs, ignore the 40, 60 divided by 80 minus 50. So let's do that. 60, divided by 80 minus 50 is 30. It's 2,000 units. So it's easier to break even on a cash basis than an accounting basis. What we'll find next, and this is the new concept, is the financial break even is harder to reach, where I'm expecting a bigger number here, usually. I think always, but I'm going to say usually. I think it's always. I think the math makes sense that it's always. But let's figure out what this is. So the financial break even, so accounting break even is when profits are zero. So obviously you want to do better than that. Cash break even is where cash flow ends up being zero. Financial break even is where net present value of the future cash flows equals zero. And again, you generally want to have positive net present value, but this is a useful number to know. So how many units do I have to sell to have my net present value be zero? And so because of that, because we're looking at net present value, this discount rate matters and the project's life matters. And the reason it's harder to get net present value of zero than to get accounting break even is because of that time value of money. Presumably your projects are making you money, but they're making you cash flows in 3, 4, 5 years from now. Well, you have to discount those positive cash flows. So that makes them less valuable. And so finance takes that into consideration where our accounting break even does not. Okay, so how do I do it? Well, I'm going to do it with my financial calculator. It is just an annuity, right? This project is essentially an annuity. And so we can do it by hand with the present value of an annuity formula. We will do it by hand at the end of the video, but I'll do it with a financial calculator. If you're fortunate enough to get to use one of those, then, this is a slightly easier process, but it's not that hard to do by hand. Okay, so here's what I'm going to enter into my financial calculator. N of this project is 5. I'm just using the same annotations that's on the calculator. IY is the discount rate, 10%. PV, the cost, 200,000 negative. So we're outlaying 200,000 negative. Our PMT, that's what we don't know. Oh, by the way, sorry, what are we solving for right now? I didn't say that. We're going to calculate, we're going to calculate the operating cash flows required to have NPV equals 0. So we calculate, and again, this is building on material from last chapter. If you're shaky on operating cash flow, that's an important concept here. Operating cash flow required to make NPV equal 0. So that's what the PMT is. That's what we're solving for. That's our OCF. And again, we can use OCF in other calculations shortly. Our future value here is 0. And so we got one variable. Let's solve for it. So N is 5. 5 goes in as N. 10 is my discount rate. 200,000 negative is my PV. My FV is 0, and I compute PMT. I get 52,759.5, but I won't take the decimals with me. Okay, so there we have it, 52,759. That's the annual operating cash flows I need, but I still don't have my break-even point. Here's how you figure out the break-even point. And it's actually using a very similar formula to this, and we're just using the cash components of it. So fixed costs, excluding depreciation, are cash. Depreciation is cash, but we have to cover more than our fixed costs because I need to generate $52,759 above my fixed costs. So I'm going to add the OCF, and I just divide by the same denominator. I'm still selling the same product. It's got the same price. It's still got the same variable cost per unit. So it's just subbing in OCF for depreciation, but it makes logical sense, right? You got to cover your fixed costs and you got to generate this much operating cash flow on top if you want to have net present value of 0, as we just sort of calculated. So fixed costs here are 60. Our required OCF to get net present value of 0 is 52,759. P minus VC is still the same, 80 minus 50. All right, so 60. So I'm just going to add 60, and now we divide by 30. and we get 3759. Now, we're in the ballpark, right, of our other units, so that's always a good sign. If it wasn't like 2 million or something, I'd be like, oh, I screwed something up. So sometimes you get absurdly high or absurdly low answers, and it just means you screwed something up. But we're in the ballpark here, and slightly higher than accounting break-even point, which we figured to be. Our break-even point for finance is 3759 units. Beautiful. So that was the key for this one. Not 8.3. We're going to move on to part D now. So again, just to reiterate what we're doing, the key to this problem is this financial break-even point. It's how many units I need to sell to have a net present value of 0. And I'll show you how to calculate this OCF by hand at the very end of the video. But let's jump ahead to part D. D says, at that financial break-even point, calculate the degree of operating leverage. This is a new concept. We explore it in some more detail in problem 8.3. For now, I'm just going to give you the formula we're going to solve. I'll explain what it is that we're calculating, what we're doing here. But we'll go into more depth when we do problem 8.3. So here is the formula. I'm doing this from memory. I always screw it up. It's 1 plus fixed cost divided by operating cash flow. That's the formula to get a degree of operating leverage, which is just a ratio. It's just a number, and it's like a number that, well, we'll explain. Let's solve it, and then I'll kind of explain what the number means. So again, this is degree of operating leverage. This is part D that we're solving for here. So 1 plus fixed cost divided by operating cash flow. Well, there's our fixed cost. There's our operating cash flow. So 1 plus 60,000 divided by 52759. 60,000 divided by 52759 equals 1.14. So 1 plus 1.14, 1 plus 1.14 is 2.14. And what you're going to get is a number, and that number is going to be somewhere above 1, obviously. It's not going to be a negative number. So it's going to be, I don't think it can be a negative number. Just thinking out loud here. Yeah, it can't be a negative number. It would be a weird situation. So it's going to be a number over 1. Typically, it's not a huge number, like unusual to be like over 6. But, between, say, 1 and 5, 1 and 6 is fairly typical. Here's what the number means. For every blank percent increase or decrease, I'll just say change in units sold, OCF will change by 2.14 times blank percent. So let me explain. So let's say units sold goes up by 10%. Okay, my unit sales go up by 10%. I would expect my operating cash flow to go up by 2.14 times 10, 21.4%. So it's a measure of how sensitive our operating cash flow is to changes in sales volume. And it's typically a measure of fixed costs, like what proportion of our capital structure is fixed versus variable. For very, very fixed, this tends to be a big number. If our costs are mostly variable, this tends to be a small number. But it's how sensitive operating cash flows are, and cash flows are really important to us, to changes or fluctuations in sales. So if sales are going up and we have big OCF, this is great news, right? If you're an investor and owner of the company, you're like swimming in cash. If sales go down and this is a big number, it's a catastrophe for you. You're in big trouble. So it's a measure of leverage, right? How much things will move. So that's the discussion point. We explore this more in problem 8.3. So let's stop the video there for those that are not going to follow along when I do the calculation by hand, just hit the thumbs up on your way out of here. No hard feelings. You can leave now. You're free to go. But for those that are sticking around, you hit the thumbs up too. And let's dig into this. I always think I'm being silly when I do that, but there's a reason people do it. It works. It works. It's really important. It helps me so much that some people hit the thumbs up button. If you're here and you haven't hit the thumbs up button, you should try it. Just try it. It's like fun. It's super fun to do. Okay. So we're just going to recalculate this number that I had done in my financial calculator. Our present value here, $200,000, that's what we're solving for, equals C, which is our payment amount, times 1 minus 1 over 1 plus R. Our discount rate was 10%, so 1.1 to the T, which is 5, all over R, which is 0.1. Okay, so again, put some brackets around everything. We just have to solve for C. C is that payment amount. Okay, so 1.1 to the power of 5, 1.61, I go 1 over x, 0.62, 1 minus that, so I go minus 1 plus minus 0.37. 0.37 divided by 0.1 is 3.79. So what's in brackets is 3.79. So I just divide 200,000 by 3.79 and I'm out of here. 1 over x times 200,000. That's one way to do this. And I get 52,759.49. Well, look at that. 52,759.49. It's the same answer because we're doing the same thing. So that did not take me long. If your professor's making you do stuff by hand, it's not the end of the world. We've solved the problem. I hope this video helped you. And for goodness sakes, if you watched all the way to the end, smash that button. Don't just hit it, smash it. Thanks so much for watching. See you in the next video. Bye-bye.